is Brian Shannon from Alphatrends.net. This man is an absolute legend, creator of the anchored VWAP. He's going to be talking today about trading with the 5-day moving average. So Brian, absolute pleasure to have you on. Great to see your face and get to talk to you today.
Yeah, good to see you, Jason. It's been a while, hasn't it?
It has been a minute. I'm really excited for you to dig in on this 5 SMA. I've been following this for some time now.
Okay, cool. Well, let's just jump right in, I guess. So I am a swing trader, and, the topic here is trend trading. So to me, it doesn't matter if we're in an uptrend or a downtrend. Of course, right now, the market is in a pretty strong downtrend. And that's where I want to look at this market and say, where are my opportunities to be long or to be short? And for some reason, why is we just tested these arrows, but it's not moving to the next screen yet. Maybe because I have that pencil there. Okay. All right, here we go. Sorry for getting you dizzy there. Here's what we're going to cover today. Just real basics of market structure. And then we're going to go, talk about different time frames. The time frame I'm going to talk about is basically the intermediate term time frame. That's where the 5-day moving average has its most value. And we'll talk about different time frames as well. We'll talk about why I use a simple moving average versus an exponential moving average and why it doesn't really matter which one you use. How we use this information to anticipate market activity, and then set up our our trade plan, which includes our stops, and then participate once we have price confirmation on a shorter term time frame. So it's all comes together through trend alignment. I'm just kind of focused on the middle time frame here. And you're probably wondering, hey, if I'm talking, well, how come we're not talking about VWAP? I've done a lot of talks about VWAP, and I think that the 5-day moving average is something I've discussed a lot, but I haven't done a formal presentation on it. And to me, it's probably the absolute most important piece of the puzzle as far as keeping me from making mistakes in the market. I make it absolutely clear that I simply will not buy anything while it has a declining 5-day moving average. I will not short anything while it has a rising 5-day moving average. Again, that comes from the standpoint, the time frame that is of a trend swing trader. So it all depends on what your time frame is. There are no absolutes in the market. It's all about what works best for you. So you've probably seen this infographic. I've been floating it around the internet for the last 12 years. I think I created it in 2010. That's what it says on the copyright, at least. And this is basically, you've seen it before, not just from me, but this is, the 4 stages of the market. Stan Weinstein and Wyckoff, they're the guys who kind of popularize this stuff. This is my version, basically, of just saying, here's where we are in a current market. I think the market itself is somewhere over here, just starting to break down. And perhaps we continue a lot lower or we can turn back higher. The fact is we never know until after the fact where support and resistance lie on the bigger time frame. We have potential areas where we look for levels of interest, as I call them, for support or resistance. But what we want to do is use a simple tool, and a moving average is a very simple tool. It gives us a reference point, just kind of a constant to compare price trend to, so that we're looking at the stock and saying, are we in an uptrend? Are we in a downtrend? Or are we sideways? Because when we're in a sideways period and prices are moving up and down, above and below the 5-day moving average, or the same principles apply for a 50-day moving average on a longer term time frame, but we're focused on the 5 here. But when we're crossing above and below, it represents indecision. Indecision is defined as stage 1 and stage 3, where we have distribution before a decline or accumulation before a drop. We only know that it's actually distribution when it breaks down here. We look at it and say, hey, it has the potential that it can break down, but it only becomes a confirmed decline once we start seeing the actual pattern of lower highs and lower lows. Similarly, on the upside, we only know that it's an uptrend when we see that pattern of higher highs and higher lows. The moving average, in an uptrend will start to slope higher, and in a downtrend, it'll go from flat to start turning lower. So we want to be aware of the direction of the moving average. where we are in relation to it, how far away, above or below we are. So looking at a 65-minute time frame, and we'll talk about why a 65-minute time frame. I talk about it all the time. And the 5-day moving average on here. What you'll notice is if you go in and put if you go into your charting platform and put in moving average and then 5, what you'll probably see is something that looks like this. It kind of follows very close to the price action. And I know this because people say all the time, hey, Brian, I added the 5 moving average and it looks nothing like what yours does. So this orange is the 5-day moving average. And what we're looking at is actually 5 days. We're not looking at 5 periods. So when we're looking at a 65 period moving average, meaning each one of these candles is 65 minutes in length, what we're looking at is the average of the last 5 days, not 5 of these candles. And that's where the confusion comes from with people who just add 5 to their chart. So what we're looking at is, again, we're looking at these stages. Stage 3 distribution. We see the price crossing back and forth above and below the price action. And what I did too, by the way, down here, I asked on Twitter for people to submit some questions, and there were some good ones. So I took them and inserted them into this presentation so that I could answer them directly. So this person is asking, what should a stop loss be if we take a stock crossing above the 5-day moving average? Well, let's first consider what the trend of this stock is. We have this stage 3 distribution here, stage 3 and stage 3, and then these stage 1s. Well, you'll notice as I'm pointing these out is the bigger trend here is clearly lower because we have a series of lower highs and lower lows. So it's not a stock we want to buy. Instead, it's a stock we want to look at and say, here's a potential short candidate. So we wait for the 5-day moving average to turn sideways, and then as it makes a lower low, below that prior low right here, we want to short it here when we have confirmation that it's made a lower low using the definition of trend. And then our stop would go up here above the most recent relevant lower high. So that's where it would go. And as the stock breaks down and then continues and makes a new low at this point, then our stop gets lowered to this point, basically break even. As it breaks down again here, we lower our stop to this point. And as it breaks down here, you might have been stopped out at this point, depending on how tight you like to keep your stop. But as the stock turns sideways, we still see the 5-day moving averages declining. So I look at it and say, it's still guilty until proven innocent. I don't want to buy it just because it's above the 5-day moving average. What I want to do, if this was a primary uptrend, is I want to buy it as it makes a higher high above the flat to rising 5-day moving average. So you can see in here, it is in fact rising. It makes that higher high. And this is AXON, by the way. I put this together last night. And, the stock had a rally. And certainly you can make money buying stocks in downtrends, buying stocks long in a downtrend. But news and surprises tends to follow the direction of the trend. And because we're in a primary downtrend, it means that it's going to drop from 180 to 140 and then rally from 140 to 160. Well, guess what? 40 points of downside, 20 points of upside. And then another, 45 points of downside versus 30 points of upside. So the sum of the declines is always greater than the sum of the rallies in a downtrend. So why not go with the bigger piece? Why screw around with this stuff and try to buy, for instance, right here at that first higher high? Instead, I say avoid it. So it tried to break higher and it instead failed. So had you purchased it there, you should have been out here. The smarter thing is, what I do is I say, anticipate in stage 3, participate as we start to break down and make the lower low below the flat to declining 5-day moving average. So short here with a stop above there. As it breaks down, lower your stop to here. As it breaks another low, you put your stop here. So there's what we want is the definition of trend. We want to anticipate in stage 3, participate in stage 4, exit in stage 1 in here. That means cover our profits. We cover pieces along the way, but this is the last point to get out. And then over here, I don't buy these. I don't buy stocks in downtrends. I see it over and over again, people trying to buy stocks in downtrends, and they continue to get slammed. It happened yesterday with AFRM. The stock had a 20, 30% run. It was up 10% on the day they reported earnings, and it was down 30%. Look at PayPal. Look at all these garbage stocks like Facebook. It's a garbage stock. There's no business buying a stock where the institutions are clearly selling millions of shares each day. So focus on the stocks and uptrends. And unfortunately, in this market right now, it means oil names. It means maybe some of the metal names are going to start to percolate in here. But the tech stocks, they're in stage 4 declines. So we anticipate. So AXON, I drew this in last night, and it's actually doing this today. I did not get shorted. I'm short Nike today. But the point is that to where we want to put our stop loss is we want to use the definition of trend. So if we short here, and this is the most recent relevant lower high, because the definition of a downtrend is lower highs and lower lows. Well, if we short here and instead the stock goes like this, well, we need to get out based on the definition of trend. If I'm anticipating a continued downtrend that becomes in alignment with the bigger picture downtrend on the daily time frame, and then it reverses, well, I'm not a trend trader anymore. The definition of trend itself tells me I've got no business being short this stock any longer. So when we talk about moving average, I use simple moving averages, and really it doesn't matter which one you use, simple, exponential, volume weighted. Volume weighted is a different category. And if you know my work, you know that I like to use that from an event. It takes out the time component, the subjective time component, and adds in, the actual supply and demand based on volume, price, and time. The simple moving average is simply, here what we'll do is the exponential puts more weight on the recent prices. This is an example, I made it up, but of how a simple moving average versus an exponential moving average works. So in the simple moving average, each piece of information gets the exact same weighting. So day 1, 2, 3, 4, and 5 all get the same weight. They get 20%. Exponential, again, I made this formula up just to prove, just to show the point. But what happens is the most recent data gets more weighting. And you can see, so day 1 might get 15% versus, yesterday we'll get 25% of the weighting. So it speeds up the moving average. And some people will talk about the 20 EMA or 21 EMA versus the 20 simple day moving average. It's completely irrelevant which one you use, because what we're not doing is using them as a place to actually do business, but instead as a reference point to say, here is a level of interest. So on here, if I hadn't labeled them, you would have no idea that the blue one is a simple moving average and the green one is an exponential moving average. So you can say, well, shoot, see how good that exponential moving average worked? Well, then, and the simple moving average person might say, well, that one worked. And over here, the simple worked, and there the exponential worked. But what we're looking at them as a reference point, and this is where we start to see if we took this piece of the puzzle right here, and we said, okay, we're going to take these daily candles, and we're going to expand them, and it looks like this. This is what it would look like. Something along the lines of that, for what I've drawn out. Now, these will be days, and I'm not good at drawing them straight here, but let's just say these were days. And then we would have right up, so what we're looking at in here is, kind of like a 5-day moving average would come down and look like this. So what we want to do is we want to look at that 50-day moving average and say that's a reference point, something to compare price to. I don't want to buy there. Now, hindsight might say, but you should have bought there. That was the low. It's not my goal to buy the low. I want to buy when there's momentum. I want to buy when the trend is in my favor. I want to buy right here, set my stop under here. If I bought right here, I have no assurance that, like this time, it wasn't going to do this and continue lower, and it would take 3 weeks to break even. And who knows, maybe you would have spit it out somewhere in here, just like this person in here. Maybe they got stopped out at break even. So I want to, look at the bigger picture for that trend alignment and say, here's the bigger trend. I'm not buying pullbacks. And if you know anything about my work, I put it on there all the time. Don't buy the dip, because we don't know if it's a dip. Instead, we use it and say, here's a level of interest. Now I'm going to switch to a shorter term time frame and look for the evidence that the buyers are gaining control. Well, at the same time, you'll see that the volume weighted average price from this peak will look a lot like that. and then we can draw one off of here that looks like this, etc. So again, what we're talking about today is a small piece of the overall puzzle. It's not a moving average system. But when we talk about a dominant moving average, and that's what I like to look at, the 5-day moving averages, the dominant moving average on an intermediate term time frame. And when I say that, dominant, it just basically means this is the most important weighting that I'm going to have on this one time frame. So I want to know, what's the direction of this moving average? What's the slope of it? Is it extended really, far above it? And I don't want to buy. I'm very picky about my buys. So if this is the stock, and here's the stock, and here's what that 5-day moving average looks like. I don't want to be the buyer up in here. I want to buy here. I don't want to buy the breakout because the breakout is late. If that was the prior high, I never buy these breakouts. And in fact, if I own it down here, I almost always sell a piece on the breakout to the breakout buyers because you'll notice, guess what? Breakouts don't typically work. People have been complaining about it for years. Hey, breakouts don't work. Well, of course they don't work because you're late. This stock already ran from 22 up to 25 and a half in 3 days. Well, guess what? The people who are up 10%, of course they're going to give you some for your breakout and your bad execution and your chasing. It doesn't make any sense to buy that stock. So how far above or below it is really, a key piece to say, am I taking too much risk here? And then, position size management. So whatever the time frame is, if you're on a weekly time frame, you might be looking at a 40-week or 200-day moving average. On a daily time frame, maybe you're looking at the 50-day moving average. Just be aware, the 50-day moving average is rising, innocent till proven guilty. Don't look to short that stock. If it's declining, don't look to buy it. It's guilty till proven innocent. That alone could save you so much money. So what you'll notice when I talk about the 5-day moving average, I almost never, in fact, this is the first time I've actually put one on a daily time frame since I can't remember, but I was trying to make a point that, so in your book, Leo says you talk about the 10 and 20-day moving average. What's the advantage of the 5-day? Is it more helpful for short-term swing trading? I think absolutely it is. The markets have speeded up since I wrote that book 13, 14 years ago. And now I've found better value for short-term. I still consult, the 20 and the 50 I talk about all the time. So what we see here is, it's not really a 5-day moving average until the end of the day. So if it's noon Eastern, the market's been open for 2.5 hours. And if we're looking at a daily chart, what we're looking at is 4 daily candles plus 2.5 hours of one day. So it's not really a 5-day moving average until the end of the day. So what is a trading day? It's 9:30 to 4. That's 6.5 hours. So, there's 390 minutes per day, meaning there's 1,950 minutes over the course of 5 days. So in order to find an even value, we have to have a denominator that can go into 1,950 evenly. So what we see is these are those numbers: 1, 2, 3, 5, 6, 10, 13, etc. So if you think about it, 195 times 10 is 1,950. So if we're looking at a 195-minute chart, that means there are 2 candles per day, and we would look at a 10-period moving average because there's 2 candles per day. We'd look at 10 periods. So here's how we look at it. We want to, again, 1,950 minutes over the course of 5 days. It's not as confusing as it might look here if anyone's going, wait a minute, taking out their phones, taking a picture so they can review this later. But in order to see the 5-day moving average, again, over 5 days, the market is open for 1,950 minutes. So we want to use candles that are evenly divided into 1950. So there's 6, I always talk about a 65-minute chart instead of a 60-minute chart. It's simply because if we look at a 60-minute or hourly chart, the market's open from 9:30 to 10. That's 1/2 hour. The candle closes. Then from 10 to 11, 11 to 12, 12 to 1, 1 to 2, 2 to 3, 2 to 4, we have 6 more candles that are each 6 hours long. So we have one candle that's measuring 30 minutes of data, and we have 6 candles that are measuring 60 minutes of data. It'd be like taking a measuring stick and having 11 inches and 1 centimeter and trying to, express things in how many feet long it is. It's not 1 foot long, it's 11 inches plus 1 centimeter. So we want to keep it consistent. 65 minutes, there are 6 equal candles per day. 78 minutes, there's 5 equal candles per day. 78 times 5 is 1950. 130, there was 3 of those per day. 130 times 15 is 1950. So when we look at, and this was through yesterday midday, this S&P 500, here's a 65-minute chart with the 5-day moving average. 65 times 30 is 1950. What we're doing is, you see this information over here, we're just zooming in on it. So we now look at a 30-minute period and we say, okay, there's 30 times 65 is 1950. Now we still have that 5-day moving average in the same spot. If we want greater detail and look at a 10-minute time frame, look at where the moving average stayed in the same place. So over 15 minutes, 15-minute candles, there was 130 of those in each 5 days. So here's how they look all together. And you can see that on the daily chart, on the 65-minute, on the 30-minute, and on the 15-minute, we have that moving average continuous on all the time frames. You don't just put 5 and then, again, if you put 5 on this, it would look like, like this. And if you put 5 on here, it would, a 5-period moving average would look like this. So we want to look at the 5-day moving average, not 5 periods for these other periods. So the way, a couple other questions I can answer here are, one of the easy stock trader said, the biggest moves are mean reversion bounces off the bottom. By using your 5-day moving average, aren't you saying bye-bye to all those opportunities? Even worse, isn't the biggest money made on the turns, which you sit out because of the 5-day moving average? Well, here's Apple through yesterday. And, the thing about it is, it seems in hindsight like, hey, well, that was the bottom. Okay, what told you this wasn't, or this wasn't, or this wasn't? This is guesswork. If anyone bought that, you were guessing. I promise it was guess. Instead, I'm okay not catching this, not being involved all through here. And instead, the day that it gaps up above the 5-day moving average, which is now rising, what we do is we simply switch to a shorter term time frame. And on that shorter term time frame, this is a 2-minute chart. So this is a 2-minute chart of this over here. These are 30-minute candles. This is 2 minutes. So it gapped up. That's this point right here. And then it immediately sold off, and we anchor a VWAP to the beginning of that day. As the stock makes this back above the flat to rising volume weighted average price, now I know that the buyers are back in control for that day, and that I can buy this stock here with a stop under there. Instead, maybe I guessed this was the low, or guessed that this was the breakout. Here I have confirmation that the buyers are in control. This is multiple time frame analysis. I wrote about this particular strategy, 13, 15 years ago, chase the gap or wait for VWAP. So it's about using multiple time frames so that I don't care if I don't catch that V reversal, because you might have thought this was the V reversal, this one, this one, this one. Instead, this way we're able to say, okay, I'm going to, keep raising my stop under the VWAP from that level. Maybe anchor one from here that starts to look like this and raise my stop up under there. But again, this isn't a VWAP presentation, so I'm trying to make it about, answering some questions as well. And this also answers Verinci's question, which is, can you show an example of entries and exits using this method on lower time frames? So there's one, and that was just in the last week in Apple, where it crossed back above the VWAP, and the biggest, most known stock on the planet. It works on all stocks. It works on all time frames. The concepts of the stock market, the technical analysis this is. Last about a week, 2 Fridays ago, I think it was, I was talking about the market and that it was starting to, we had seen that, this was the low was actually, you can't see the low. The low occurred on the 24th of January, which was over here. and it kind of did this, rallied up, got rejected at the 5-day moving average. It got above the 5-day, but the 5 was declining, 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 declining. And then on this day, we had a gap over here that came down to this. So I knew that the 5-day moving average, I was anticipating the direction of the 5-day moving average to rise. So I put on Twitter that I had got long here with a stop under that level. I got in and out of the trade. I also then said I got back in. I got back in here because I thought that was a shakeout. So, I'm not buying big pieces in here. This is a reversal trade. The 20-day moving average, the 50-day moving average are still declining. This was a high risk trade, even though, it hit the parameters for a, buy above that 5-day moving average. We were deeply oversold. Everyone was bearish and it was starting to turn. We had evidence. So I'm a trader. I'm going to take the trade. It's not my preferred trade. I prefer to trade when we have an alignment of trends. If I trade this long side in a primary downtrend, it's going to be with smaller share size because I have less confidence in it. And I'm typically going to go to something like the S&P versus trying to pick a bottom in a stock, because a bottom in a stock is much more elusive. The S&P, we can see, there's not that company specific parameters that are going to be a problem. So trend traders, you want to trade in the direction of the primary trend, and the simple moving average or exponential, who cares, right? Don't try to be all intellectual about the exponential is better because of this weighting or that. It's a bunch of horseshit. Either one is going to tell you the same exact thing in the same area. It's a level of interest to drill down to a shorter term time frame and look for evidence that the buyers are gaining control. And then if you find that evidence, you buy and set your stop. Risk management is always job number one. So if we are in a primary uptrend, so we have a stock in a primary uptrend, if it's in stage one, basically right here, we anticipate. We don't do anything. And then as it breaks to stage two, we participate. And then as it makes these higher highs and higher lows, we stay in and then we exit in stage three as it turns sideways. Let's say it looked like this. We exit in stage three, and then I'm going to avoid that pullback because it's most likely going to do this. I'm not looking to sell short this. But if instead we're in a primary downtrend, we flip it. It's the opposite. We anticipate in stage three, participate in stage four, exit stage one, avoid stage two. So the direction of the moving average is going to be more important than whether it closes above or below it. Be aware of that. Be aware of how far it's come. Has it expended all of its energy to get there? If the 5-day moving average on an intermediate term trend is declining, I look at it and say guilty till proven innocent. But I'm also looking at where were we 5 days ago? What data are we replacing right now? Does this have a chance that it's going to flatten out? And if it breaks that higher high, I don't want to chase it the next morning. I want to be involved today. So there's all kinds of pieces. This is by no means a system of trading. It's one piece of the puzzle. I use, the weekly time frame. I use the daily time frame. I'll use the 65, the 30, the 15, the 10, the 2. I'll use whatever time frame I can get value from to help me hone in on what's the best point of action that I can get involved where the buyers just start to take control, or right now where the sellers are starting to take control, so that I can get in right as the momentum begins. And that allows me to be aligned with the trend. So I know, we're in a downtrend. I want to short that very first weakness on the shorter term time frame. I can go in with bigger size because I know I have a tighter stop. If I'm risking 50 cents and per share, and I'm risking $1,000, well, I can trade 2,000 shares. Instead, if I wait for the stock to drop $2 and then I enter it, and my stop is $2 away, to risk that same $1,000, I can only trade 500 shares. I want to be as precise as possible because it allows me to maximize my gains for the same amount of risk. So again, it's a reference point. It's, if it's below the 50-day moving average, the 5-day moving average, whatever your time frame is, it's guilty till proven innocent while that moving average is declining. Even if it pops its head up above it for a day or two, if it's still declining, don't trust it. Only price pays. And whenever you get involved in a stock, ask these two questions. Where has it come from? I can't tell you that it happens all the time. When we're in a downtrend, I get questions right here about, hey, does this look like a short? It just dropped from 53 to 36. Hey, Brian, I think that looks like a short. No, it's where has it come from? Instead, I want to look at it and say, okay, now it's just starting to break down. Where has it come from? Well, right here, I can set my stop there. Where does it have the potential to go? Well, at least to this level. If it breaks down to there, I'm going to cover a third of it. But if it's truly in a longer term decline, who knows? Maybe it goes off the chart, into bankruptcy, hopefully, if I'm short the stock. Not to wish anything against the company, but, we want to make as much money as possible. So where has it come from? Where does it have the potential to go? That's how you determine your risk reward ratio. Is the potential for profit worth the perceived risk? And it's perceived risk. What if the stock gets bought out tomorrow and we're short it? We're stuck. That's why we have the position size as well. It's garbage in, garbage out. But we can put less smelly garbage into the equation by looking at the definition of trend and anticipating, understanding market structure and anticipating how it flows. I wrote all about it in my book. You can find it on Amazon. It's been called one of the top 10 trading books ever written. Don't forget, only price pays. That'll do it, Jason. Hopefully I came in on time or for what you guys are looking for.
Yeah, no, that you totally crushed it, Brian. That was awesome. I do have like maybe one or two follow-up questions for you on a couple of things.
Sure.
The first thing I'm curious about, it's actually kind of like just a single two-part question. On the example that you showed us with Apple, where you have the gap up, now price is above the 5-period or the 5-day moving average. And then you go down to the 2-minute and anchor off the start of the day to determine an entry point. Is that a
Yep.
pretty common process for you? Is that kind of how you would normally do something like this? I would think we would be looking for that gap to fill. We would be looking for a back test of the 5 SMA. So yeah, if you could kind of
Yeah,
just expand
that
on that
is
a little bit.
because, we were so sold out in this market and Apple being the leader that, not all gaps get filled. It's a fallacy that if they do get filled, a lot of times it doesn't matter for months. So, when the momentum is there in the market leader, the biggest stock on the planet, the one that's been really holding up better than anyone else, the stock who reported earnings and it rallied while all the other stocks, a lot of the other stocks have been crushed on earnings. So it's not typically going to get filled. And the point here to this entry, Jason, and this is, again, I wrote an article about this called Chase the Gap or Wait for VWAP, because I used to wait for things like what you were saying, waiting for it to come back down and retest, that prior support resistance, which it did actually, or test the 5-day moving average and then get going. I got tired of, missing all these moves. So I discovered that, and this is a traditional VWAP. When I say anchored to, that's just a traditional VWAP. It's automatically anchored to the beginning of the day. But this tells me that, hey, something significant happened here on this gap higher. The market was oversold. We've seen a higher low in Apple. That 5-day moving average will begin to, starts to begin to rise here because we're getting rid of data from the beginning of the day 5 days ago over here. So if I don't chase that gap, let it settle down a little bit, and you can see it, it rallied up to 167 and came down to, 133. That, if you bought at 167, it's down at 163 in 3 minutes. I'd feel like a jackass personally. And so instead, I want to say, where do the buyers regain control for the time frame I'm entering? If I'm entering on this short-term time frame, really it just takes out this little high right here. It's above the VWAP. And then if I want to get involved there because I think this has the bigger potential on a longer time frame, and then set my stop under the low of the day, I know exactly what my risk is. So if it's 2 points and I'm risking $1,000, I'll buy 500 shares there. If it's $1 per share, I'll do 1,000 shares, let's say, if my risk unit is $1,000. So, as it makes that quick move, I'm almost always taking a third off. Then as it starts to do this, once it gets to this point, I raise my stop on the 2/3 balance right to here. So if it comes back down, I get stopped out. Well, I've taken a third off somewhere over here. I'm entered there. All three pieces are profitable. I'm certainly not going to let it come back down and take me out at a loss. And then I might, for half of that third, I might say, okay, it makes this high, it pulls back, it rallies up to here.
Yes.
Now I'm setting my stop on that second third right here. I get stopped out. I've got 1/3 left. I let it test DWAP. It comes back up right here. Say, okay, that's where my final third will be. And maybe I'll even add to it some of the stuff that maybe I'll add a third of my original piece right here and put my entire stop under that level. And as it rallies quick, if I added another third, I would probably sell a third here most likely. And then I would start doing the same process, raising it up under these higher lows, and then probably getting stopped out as it turns sideways in here and saying, good enough, on to the next one. That's how I like to